When an investor is thinking about a core plus investment opportunity, so the first thing you should be looking at is location. And location is both the city itself. Is the city a place that provides liquidity for that investment, and submarkets within those cities that provide that liquidity? Number two is vintage. With core assets, you really do want newer assets. I would say in core plus, you can go a little bit older because a core plus asset comes with the recognition that you're going to potentially spend a light amount of capital towards making that building better for the tenants, but you're not spending a lot of money, because if you do, you're really segueing into value add, and I'll cover that in another video. Core plus is saying we can invest small amounts of money into the building to increase that cash flow stream. And oftentimes that can also be done with better management. And lastly, you're looking at cost cutting. So are there ways that we can cut costs at the asset, but not the perception of value? The other thing with core plus is how much debt you use in the asset. So if you get everything within this frame, but you then use too much debt, it's no longer core plus. Core plus deals tend to be anywhere from 40 to 60% leveraged, and that's a very wide range, but if I had to tighten it, I would say 45 to 60%, whereas core more like 40 to 45. An investor that invests either directly or into a core plus fund is looking for an 8 to 10% return annually. These returns have come down, probably 10 to 20%, but this is true of every asset class: public stocks, private equity, venture. The expected value for any unit of risk is a bit lower. So I would say that in core plus, 8 to 10% is the correct amount to expect for this unit of risk. We really view core plus as sort of a combination of dividends and growth. As an investor, if you're looking for those types of companies in the stock market, a substitute good would be a core plus investment in real estate or a core plus investment in a real estate fund.